Welcome to this episode of PhillipCapital Market Watch. I am Ming Wei, Equities Specialist from Phillip Investor Center, Payoh. Today, we will explore a topic that has significant implications not only for China, but for the global economy as well. The recent cuts to China benchmark lending rates. As the Chinese government continues its efforts to stimulate economic growth, we will explore the reason behind these decisions and its potential impact on the Chinese economy. Let's begin with a brief overview of benchmark lending rates and the recent monetary policy changes in China. This rate set the foundation for borrowing costs across the economy, influencing everything from business investment to consumer spending. Recently, China implemented significant cuts. The one-year loan prime rate was reduced from 3.35% to 3.1%, and the 5-year rate dropped from 3.85% to 3.6%. Additionally, the central bank lowered the benchmark 7-day interest rate from 1.7% to 1.5%. To further enhance liquidity, the People's Bank of China is also cutting the reserve requirement ratio by 50 basis points, allowing banks to lend more effectively. These measures come in response to concern about sluggish economic growth and weak borrowing demands. Notably, the minimum down payment for second homes has been reduced from 25% to 15% to revive the struggling property markets. Overall, this measure represents a crucial step in the government's strategies to combat economic stagnations and are part of a broader stimulus package designed to revive economic activities. Recent reports suggest that the PBOC introduced these cuts as part of its most aggressive stimulus measures since COVID pandemic. The central banks aim to halt the ongoing housing market crash and reverse the broad decline in prices. By allowing state-controlled commercial banks to lend more of their assets, the PBOC hopes to inject around 140 billion into the economy. Governor Pan Gongcheng has indicated that further lending support could be provided if necessary, showing a clear readiness for continual interventions. Now, let's examine how the PBOC recent actions are impacting businesses and consumer spending. Firstly, a significant result of the rate cuts is the reductions in borrowing costs. The interest rate cuts have significantly reduced expenses for businesses, encouraging them to secure loans for expansions and investment. This in turn can lead to job creations and stimulate broader economic growth. Next, these measures are boosting consumer confidence. With lower mortgage rates and reduced down payments, families are finding it easier to purchase homes and make significant investment. This increase in consumers' confidence can drive spending in retail and services, which is crucial for economic vitality. We should also highlight the revitalizations of property markets. The reductions in down payment for second homes and lower mortgage rates are likely to stimulate demand in housing sector. This in turn benefit developer and related industry, creating a wow effect for homeowners, which can further encourage consumer spending. Finally, it is important to acknowledge the sector-specific impact. Different sectors will respond to this change in varying ways. For instance, the real estate sector may see immediate benefit, while sectors reliant on discretionary spending might take longer to recover. Small businesses may also face challenges in accessing financing compared to largest corporations. In summary, the PBOC's recent actions are set to significantly impact businesses and consumer spending, laying the groundwork for potential economic recovery. While there are potential benefits to the PBOC recent rate cuts, it is important to acknowledge the significant risks that come with these measures. Continuous rate cuts may encourage excessive borrowing amongst businesses and consumers, potentially leading to asset bubble. With lower borrowing costs, both individuals and companies may take on more debt than they can handle, which could inflate prices in sectors such as real estate and equities. Additionally, while the Chinese market remains relatively cheap, with a PE ratio of around 9 or 10 times, its potential for growth depends on the effective fiscal stimulus. The current monetary measures alone may not fully address the underlying demand issue. Although the market has seen a significant rally followed by a pullback, it still offers values. However, future growth will likely depend on the scale and timing of the additional fiscal measures. Long-term structural challenge may also limit economic expansions to around 3% over the next decade. In summary, while the PBOC rate cuts aim to stimulate the economy, they also bring risks like excessive borrowing and potential asset bubbles. It is crucial to monitor this development closely as they will significantly impact investment confidence and the overall economic landscape. That's all for PhillipCapital Market Watch. Do remember to like and follow us on our social media platforms and subscribe to us on YouTube. Leave your comments. Thanks for joining us and see you again next time.